Remote work, crypto, and enforcement. Top 3 international tax trends for 2022 and beyond. Hi, my name is Renalyn. I'm with HTJ.tax, the international tax firm for 6, 7, and 8-figure investors and entrepreneurs who are living that international life. Today, I wanted to discuss what we think are the top 3 international tax trends that you need to keep in mind as you speak with your advisory teams. Are you ready? Let's find out. The number 1 trend to watch is remote work and permanent establishment. Remote work is one of the many trends that were accelerated by the health crisis that started in 2020. Today, the tax consequences of remote working is an issue we face regularly with many clients. Poorly advised entrepreneurs and investors are surprised to discover that running a company formed in Jurisdiction A while living in Jurisdiction B may create corporate tax exposure for your company in Jurisdiction B. They form a company in a Caribbean jurisdiction, for example, and operate it from their home in the US, Europe, or Latin America, and are confused that their overseas company may be taxed where they live. This is because of a principle called permanent establishment. Let's take a closer look at permanent establishment. Under Article 5 of the OECD Model Tax Treaty, companies can form a permanent establishment in a country in one of 2 ways. First, a company resident in one country may form a permanent establishment by having a fixed place of business in another country, which, subject to certain exceptions, includes a place of management, branch, or an office, among other things. Important to the fixed place of business analysis is that the location, A, must be used longer than temporarily, and B, merely needs to be at the disposal of the enterprise, which includes non-exclusive space. Second, a permanent establishment may arise when there is a dependent agent. What does this mean? It may arise where a person based in the foreign jurisdiction acts on behalf of your company and habitually concludes contracts binding on it. Third, certain tax treaties also provide an objective test for a third category of permanent establishment based on performing services in another country for a given period. For example, the U.S.-Canada Income Tax Convention states that even if an enterprise does not have a fixed place of business or dependent agent permanent establishment, a permanent establishment still exists if an individual performs services in either country for more than 183 days per year and accounts for more than 50% of an enterprise's revenue. So to summarize, your company may be subject to corporate taxes in another jurisdiction when you have a fixed place of business there, even if it is a non-exclusive space. Care must also be taken when there is an employee or key decision-maker based in another jurisdiction, even if they only work from their home there. Finally, companies need to be mindful of more than just where their employees are located when they sign contracts. According to the OECD Model Treaty commentary, a contract may also be deemed concluded for purposes of a dependent agent permanent establishment simply by accepting an offer or by fully negotiating the elements and details of a contract in a way that binds an enterprise. So, as you and members of your team do business in various jurisdictions, get advice from qualified professionals. The number 2 trend to watch. The IRS and other tax authorities may continue to seize billions of dollars in virtual assets. The Internal Revenue Service in the U.S. seized $3.5 billion worth of cryptocurrencies during fiscal year 2021. This figure accounted for 93% of all the assets seized by tax enforcement that year, according to an IRS criminal investigation annual report. We are routinely contacted by crypto investors asking for ways to legally avoid paying taxes on large crypto gains. Aside from lost harvesting, moving to Puerto Rico, using charitable remainder trusts, and opportunity zone investments, it is extremely difficult for U.S.-exposed persons to legally avoid taxes on crypto gains. Surrendering a U.S. passport and/or U.S. residency may trigger a painful exit tax, but it does give access to crypto-friendly jurisdictions like Portugal, Singapore, or certain Caribbean jurisdictions. The IRS Criminal Investigation Chief, Mr. Jim Lee, is on record as saying that he expects the trend of crypto seizures to continue into 2022. In 2021, the IRS's criminal unit seized billions of dollars worth of Bitcoin and other virtual currencies connected to cases involving a range of criminal activities such as wire fraud, money laundering, and of course, tax fraud. That included $1 billion stolen from the Silk Road, an online Bitcoin exchange that was shut down in 2013. The unit also prosecuted a former Microsoft Corp software developer who used cryptocurrency to hide $10 million that he allegedly embezzled from the company. The Criminal Investigation Unit has prioritized training and the deployment of cryptocurrency, blockchain, and open-source intelligence technologies to unravel complex cyber-financial criminal schemes, the division said in its report. To further advance those efforts, the unit is opening an advanced collaboration and data center in Northern Virginia in 2022. Congress recently granted the IRS more power to surveil cryptocurrency transactions in the 2021 infrastructure package. That law will require crypto brokers to track and report transactions to the IRS in an effort to give tax authorities more visibility into virtual currency trades. The agency plans to hire more than 250 to 300 more special agents, as well as invest in systems to identify and track cyber crimes. So the takeaway? The sooner you get advice and come clean by legally declaring any and all gains on your virtual assets, the better off you will be. The number 3 trend to watch is more enforcement overall. It's probably worth pointing out the obvious. Most jurisdictions are facing financial pressures. On one hand, tax revenues may be down as businesses and individual taxpayers face lower income. On the other hand, governmental expenses are higher given the additional costs imposed by the pandemic. Tax authorities such as the IRS in the U.S. will therefore pay closer attention to related party transactions, among other matters. The taxation of related party transactions falls within the spectrum of the discipline of transfer pricing. Many of our clients run companies in different jurisdictions where corporate tax rates may be very different. There is therefore an incentive to shift profits from a high-tax to a low-tax jurisdiction. Tax authorities are very aware of this and look to something called transfer pricing policies to police this. Speak with your advisory team about this, as transfer pricing is a hot topic right now. At HTJ.tax, my colleagues and I, we believe in getting to know our clients. We have a comprehensive questionnaire to help us to get to know our clients before recommending a certain residency or citizenship. We trust math. Our team is able to run simulated tax returns so that we can quantify the tax savings before the client makes a move. Or if a move actually increases a client's tax burden, at least they make the decision with their eyes wide open. So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at HTJ.tax and live that international life.